Hey guys, what's going on? Welcome into the video. So in this one, we're going to be talking about all of the current bullish versus bearish arguments and catalysts in our market right now, what it's going to take for this market to bottom, and some important price points and levels to watch on the market moving forward, which can potentially trigger a breakout / reversal, and all the catalysts needed that we need for this market to reverse. Alright, so getting into it first and going through the bullish arguments on the market. The biggest thing in the market right now is inflation. That's our biggest issue for the economy. So bulls believe that inflation has peaked at this last CPI print, or will peak by mid-year this year. I personally believe that the 8.5% year-over-year print from the March CPI report is the highest we will see, and the 8.3% number we got from April's data can potentially start this new trend down, but it just all depends. Anything can happen moving forward. But during all of the recent market crashes, the market did not bottom until the Fed pivoted their stance. So the biggest question now is when the Fed will pivot this time, and that will likely be when they are confident the inflation is and will continue to trend down. The next bull argument is that valuations that investors have been waiting on since mid-2020 are here. If you remember in 2020 and 2021, when stocks were flying high, there was a record amount of insider selling, companies raising cash from their high stock prices through offerings. Well, now we are seeing the insider transaction level, which measures the ratio of sales to buys, at historically bullish levels if we take a look at this chart right here. Now also, according to Yardeni Research, forward PE ratios are at the lowest point for mid caps and small caps since 2011, if we ignore the data from the 2020 crash, which of course was an outlier from a lot of other crashes since it just happened in 1 month. So large caps are still high based on historical levels. For example, it's weighted heavily towards the mega caps, such as Apple and Microsoft, who have around a 23 forward PE, so that of course raises the broad PE for these large caps. Also Nvidia, which has a forward PE in the high 20s, Tesla, which has a forward PE of 50 but growing very fast, and Amazon, which has a forward PE of 40 but has not yet prioritized profitability in their business. So all of those mega cap companies skew the data to the upside so that forward PE does look higher. And if this chart was more equal weighted, the earnings multiples would likely look a lot cheaper for large caps. So that is one thing to note by this data. Also, the entire market has had a super negative view. This is one of the worst starts to the year of all time. The bearish sentiment is through the roof, greatly explained by the fear and greed index, which shows that we are in extreme fear territory, which of course has always been historically the ideal time to buy stocks. And also, we have already seen massive 70% plus crashes on everything that was heavily overvalued before. For example, ARK Invest has revisited the lows, was about 10% away from those lows this past week from the 2020 crash, which is just insane to think about. That huge massive run it had, the full bubble popped, and now we are back down to COVID lows. We have also now seen those expensive software names, companies such as Cloudflare, ticker symbol NET, Sentinel-1, ticker symbol S, and Confluent, ticker symbol CFLT, finally dropped big in the past couple weeks, which has been needed. They were trading very expensive before, so we're seeing these valuations come down in sectors that have been needing it. And in a way, we can compare companies like these and ARK companies to the early 2000s tech bubble, in which we've seen this valuation bubble pop. But the thing that separates us from the tech bubble is that our companies are now much stronger and more developed than ever. For example, the market leaders in Microsoft and Apple, Amazon, and Google, these are all essentially monopolies that print money in our cash flow machines. Now compare this to the leaders in the early 2000s, such as Intel and Cisco, which valuations and business models were much more questionable at the time. We have much stronger moats in our companies today. And those companies, for example, Cisco and Intel, they still have not returned to those past highs, something that we do not need to worry about with the Apple, Microsoft, Google, Amazons of this current world. This is the biggest difference between our market currently and the dot-com bubble, which we do see a lot of arguments all over the place right now that this is the second coming of the tech bubble. Maybe it is in those expensive software and those expensive growth hype names that did not have many fundamentals backing the moves, but you cannot compare our tech companies today to those dot-com companies that were just a website and a name and had very little revenue and cash flow. And our current crash today is not like the 2007 to 2008 great financial crisis either. Back then, investors lost faith in the US economy. They thought that the housing market would never be the same again. They thought the economy would never be the same again, including the stock market. That is totally different from today. I don't think any investor is really worried about our stock market going to new highs in the future currently. I think that a much better comparison currently is our crash, comparing it to the 2018 crash. This is when the Fed tightened, the market had a violent drop, but recovered to new all-time highs not long afterwards. Now granted, our current situation is worse. off than what it was in 2018, but this is much more of a valid comparison to then those crashes in the early 2000s. Now, a few more bullish takes that I want to get into before we get into the bearish arguments. There is a lot of cash on the sidelines. Investors are just sitting there waiting to go in whenever the market does bottom and start confirming a reversal. There's a quote that says that the buyers are higher. I think that's a perfect quote to describe our market today. There's a lot of people waiting on the sideline because they don't want to go through this current drawdown to pain. But if they see the market start going up again, that is when they will buy, boost the stock market up more, and the reversal can happen very, very quickly once we do bottom and start to reverse back up. Another big thing currently is that GDP was negative last quarter. If we get one more quarter of negative GDP, then we are currently in a recession. So there's a real possibility that we are in a recession currently. So historically, there have been no better times to buy stocks than in a recession because that's when sentiment is pretty much at its worst and can only get better from there. Okay, so now let's get into the bearish arguments. So the number one thing is now that the rate hikes have started, the Fed has no plans to stop hiking rates and to pivot until something drastically changes on the inflation front. Based on the data, this is likely to lead us into a recession, whether that's currently, whether that happens in the second half of 2022 or the first half of 2023. That is a real possibility, and while currently the market is likely pricing in us to go into a recession, in my opinion, that does not mean there cannot be more fear and downside when we actually are in one. And the Fed is not here to save the stock market, and they could not care less that the S&P 500 is down about 15% year to date. Their only purpose currently is to get inflation down and ideally not cause a recession, but Jay Powell has stated that a soft landing is far from a guarantee. And in our current environment, there is near record low unemployment, and this is one of the top things that the Fed pays attention to. Low unemployment equals a healthy economy on paper, which gives them no reason to stop raising rates and no expectation for us to believe that they will stop raising rates anytime soon as long as our economy is as healthy as this with very little unemployment. The real estate market is also likely going to see a substantial downturn in the foreseeable future due to the massive interest rate increases. If the real estate market makes a substantial downturn, which does feel likely right now, this will lower consumer confidence, which turns into lower spending. And what does lower spending do? Of course, that can cause a recession and also cause bad earnings from companies, which of course makes stock prices go down. And getting into the crypto market a little bit, let's be real here, the NFT market is still very, very frothy. Bored Apes have around a $200,000 price floor right now, and that's even after a 36% drawdown, and CryptoPunks have around a $100,000 floor after a large drawdown as well. Now maybe I'm missing something here with NFTs, but in my opinion this market is just based on the greater fool theory. 90% of investors and traders buy these for the expectation that somebody will buy it from them for more in the future. There are not many real world use cases for these besides some cool benefits with the community. And the NFT market just seems like the definition of a bubble for me. But hey, maybe I'm missing something here. But my question is, if the market can really find a bottom when these NFTs are still selling for hundreds of thousands of dollars, I guess we will find out, but that's something to pay attention to, no doubt. And there can also be an argument made that we need the crypto market to have a full implosion before our stock market actually bottoms. We saw a pretty substantial drop this past week due to the Luna fiasco, but it feels like a matter of time before we see larger drops in the crypto market. And since crypto and stocks do have a lot of correlation, that is a possible catalyst to send the market down further. And I am a long-term believer in crypto. I just feel like this current environment is pretty much the worst possible environment for the crypto market currently. And don't get me started on Tether USDT. That's an absolutely massive risk to crypto. That's a story for another day. What could happen if Tether kind of imploded? Also, Dogecoin has a $11.5 billion market cap and Shiba Inu has a $6.5 billion market cap. Here's a question for you guys. Can the market really bottom if these dog meme coins are still trading this high? Maybe so, but the question is, do we need all of these bubbles to implode before the broad market bottoms? That is a real question here. And the bearish argument based on technicals is that we have not seen real capitulation yet. Now, what do I mean by that? In past market crashes, a bottom finally happened once the VIX had a massive spike to 50 minimum and had moves above 80 in 2008 and in 2020. Once these max fear events happens, that is usually what washes out the final panic sellers and signals a bottom, but that is something we have not seen yet in this current crash. It just feels like a slow trend down with no real panic yet. It's just gonna be kind of like slow and steady. We need that immediate huge drop to finally make its bottom. Maybe this time is different, but history does say otherwise. Capitulation and bottoms can also be signaled by volume. When a bottom is found, there is often a spike or increased volume, as shown in the 2020 crash, in the 2018 crash, the 2008 Great Financial Crisis, and the 2000 tech bubble. Looking at our current downtrend, we have not yet had that volume spike / capitulation in this market, and there is an argument that this market will not bottom until there is a real capitulation event. Now, some of the biggest levels that I'm watching on the S&P 500 or the SPY for this market to have strength for reversal is currently on this current balance. We've seen like an oversold balance on Thursday and Friday. What we need, at least this week, to have follow through in a larger relief bounce is SPY needs to break above 405. If it can break above 405, that can send us on a large relief bounce, and that is a big spot to watch this coming week. And 430 has been key resistance for a while. If we can break and reclaim above 430, I think that can give us an even larger rally and potentially break through kind of full reversal in the market. But if not, more downside does look like the likely scenario in this market, and these have just been more of bear market rallies, not necessarily bottoms. So that's my thoughts on the current market, the bull versus bear arguments. I'm personally very bullish at these current levels. For the long term, who knows what's going to happen in the short term? The current expectation that I have is we do end up going lower in the short term, but I would not be surprised by anything in this current market. And there are some stocks looking very cheap and attractive at current levels that will likely give triple-digit returns in the coming years. So a lot to get excited about in this market. Hope you guys enjoyed. Hope I added some value to you. If so, make sure to hit that like button and subscribe button. I would greatly appreciate that. For anybody interested in joining the private Discord chat, that is the first link down in the description. Thanks so much for watching, gals. I'll catch you all next time. Peace out.